Hi and welcome to my channel. My name's Charles Delastic. Today's video is, I believe, quite important to almost everybody, and it's around the problems with making a basic will. So although I would always say never make your own will, and most people would tend to use a local solicitor, and I would say yes, that's sensible, you should always have a will. However, for people with higher levels of value within their estates, £100,000 and over, that particular scenario is likely to cause some problems down the line. And this video is all around what those problems are and how you can fix them. Okay, without further ado, let's get into the intro. Hi and welcome back. So what are the problems with making a basic will? Well, if done properly and you choose the right people, the correct people will get the correct assets. However, there is a big problem. There are no protection for those assets. And if you pass the money directly through your will from your estate to your beneficiaries, they will have full ownership. Now, as I said, that's fine for people with assets of less than 100,000. But if you own, let's say, a property and the value of your estate is likely to be over £100,000 when you both die, and particularly for people with assets of over 1.5 million, just a simple basic will is not a sensible strategy. Okay, so there are 5 main problems with a basic will. Number 1, divorce. Now, it's obvious if you leave your money to your children and one of them gets divorced, and let's face it, with a divorce rate of over 50% in the UK, half of the money that you leave your children could potentially walk. And that's actually a bigger problem than inheritance tax. The second problem is potentially bankruptcy. So money could go to the creditors. So either one of your children or their spouse goes into their own business, their business goes bankrupt, as does happen in an awful lot of cases. So the money that you leave them could potentially get lost. And in fact, all of that is then open to debate. Once again, a much bigger issue than inheritance tax. Now, these next ones are probably not as obvious. So if one of your children dies and then the spouse gets remarried to another person, the new person may not have raised their children, in other words, your grandchildren. So if the spouse remarries and they have a normal basic will, that means when your child dies, all the money goes to their spouse. Then effectively, when their spouse dies, their new spouse, they may not leave any money to your grandchildren. And therefore, that's probably not what you want to happen. You want it to go to your children and then on to your grandchildren. Now, another issue is if, heaven forbid, your children die young and they die young, leaving your grandchildren under 18. Well, if both parents die, leaving the grandchildren under 18, at age 18, those children will inherit everything, which obviously is a little bit early for people to inherit an awful lot of money. So that again is not a sensible strategy, but that's exactly what would happen with a basic will. Last but not least, if you've left your money to your children, and let's say you've not taken any planning to avoid inheritance tax on your estate, they will pay 40% of the assets over your allowances, which is generally £1 million for a married couple if you own a house, including the residential nil rate band. So if it ends up that your children pay 40% tax, by the time that same money gets left to your grandchildren, they will pay another 40% on that same money. So you see, it's been taxed at 40% once, now it's taxed at 40% twice, which is an effective tax rate at 64%, simply because you put a basic will into place and didn't do any sensible planning in time. So that's obviously another major problem. So those are the 5 big problems with basic wills. So now we'll get into how you can avoid those. Okay, so what should you do instead? So instead of setting up a basic will, you should set up new wills and embed lifetime trusts within those wills. So basically your wills leave all your assets to lifetime trusts. In other words, these are trusts that you set up during your lifetime. So you would need more than one trust. Now that depends upon the number of children you have and their tax issues when you die. But having more than one trust, which you can do during lifetime as opposed to on death, when you die you can only set up one trust. Well, you can set up more than one, but they're taxed as if they were one trust, so it makes no sense. So but during lifetime you can set up a trust on Monday, another one on Tuesday, another one on Wednesday, depending upon the number of children that you have. And having those separate trusts mean that the money gets split into those trusts between your children according to your wishes, and then each of them can do with their own trust as they see fit, depending upon their circumstances. Now, if you decide to do this kind of planning, do not just adjust your old wills, because if you end up with new lawyers doing your trusts and you've still got the old wills written by previous lawyers and there's a problem, then the two lawyers will end up blaming each other, and then there's all sorts of issues which could have massive ramifications upon your estate. So always get new wills alongside the new trust, and they're set up specifically as a package to make sense, and the lawyers have done both of them, so if it goes wrong you know who to blame. But ideally we would use highly effective and very experienced lawyers to make sure that none of that happened. So really that's around the problems with the wills, in case you decide not to go forward and you just use your old one. Really the saving isn't worthwhile, so I just wouldn't go there. Okay, so how does the new mechanism work that I'm suggesting that you put in place? So I have produced an in-depth video to explain how this works, but I'll just go through it in basics. The in-depth video is called "Is Estate Planning More Important Than Inheritance Tax Planning?" But how it works is very simply this. So when you die, when the second person dies, definitely, all of the asset gets given to the trusts that you've set up during lifetime. The trusts then loan the money to your children. So let's say it's £500,000 each, right? They get written a cheque for £500,000 or a transfer from the trustees, who are generally your children anyway, because it's a family trust. So they are the trustees and the beneficiaries. But instead of that money just being passed directly to them, a separate agreement is drawn up saying that it's an interest-free loan repayable on demand for the rest of their lives, and it's only repayable should the trustees demand it. But the trustees are the children and the beneficiaries, so they're actually controlling both ends. So what that does is that if one of your children unfortunately goes into divorce or goes bankrupt or any of the 5 problems we're talking about, the loan is recalled back into the trust, right? And then after the divorce is settled, then the money is loaned back out to the relevant child. So you could see how that would protect it in divorce. But watch that main video, as I say, because that has an in-depth explanation on all 5 on how that particular mechanism works to solve the problem for all of the 5 problems I previously mentioned. Now you will find there's also a possible tax saving for people with large estates where their house values exceed 650,000. So certainly for people with bigger estates, this is absolutely the most sensible thing, and pretty much every client that I've talked to about it goes ahead and proceeds, because the costs and the savings are really nonsensical. The savings are so big relative to the costs. So the main point of this particular arrangement, though, is not inheritance tax saving, although the inheritance tax saving made for people with larger estates more than offsets the cost of setting up this planning. It still is being done to protect against the 5 problems, not for the inheritance tax. We would deal with that completely separately. Okay, so in summary, basic wills only direct the assets to the people that you want them to go to. So I'm not saying don't do a basic will. I'm saying if your assets are likely to exceed 100,000, when the second person dies, you need something a little bit more complex to make sure that there are savings and protection for your family down the line. Really, that's the point of this particular video. Hopefully that makes sense to you. If you enjoyed this video, please give us a like and subscribe to our channel, as there's lots more to come around inheritance tax and estate planning on this particular channel. So thanks for listening and goodbye for now.